Hi everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. My name is Ketan Ramachandra, and in today's podcast, we explore the intricacies of economic concepts and their impact on financial markets. Specifically, we're diving into the concept of a soft landing in the context of economic growth, labor market strength, and interest rates. Now, soft landing is a phrase that we may have heard quite recently, right, over the last couple of months of last few months, right, in financial media as well as regular news headlines as well. Now, what exactly is a soft landing? In pure economic terms, a soft landing refers to a scenario where the economy slows down gradually, avoiding a sharp downturn or a recession. It typically involves a moderation in economic growth to a more sustainable pace without causing significant disruptions to the labor market. Now, that means the unemployment rate could pick up a little bit. However, it should not blow into or should not escalate into a full blown unemployment for the entire country. Right now, this is quite important. Now, this is what basically is the gist of a soft landing. So, we're trying to slow down economic growth without creating a huge spike in the unemployment rate. Now, let's train our focus on the US with regards to this soft landing. Can the Federal Reserve engineer such a soft landing? And if so, how could they do it? The Federal Reserve plays a key role in guiding the economy towards a soft landing through its monetary policy tools, particularly interest rate adjustments. By carefully calibrating the pace and magnitude of interest rate hikes, the aims to temper inflationary pressures while ensuring that economic growth remains stable, as well as the unemployment rate. Right, so the labor market uh, has to remain relatively strong as well. Right, so that means that the Fed also will monitor closely indicators such as unemployment rates, wage growth, and consumer spending to assess the health of the labor market and overall economic activity. By providing forward guidance and communicating its policy intentions transparently, the Fed seeks to manage market expectations and minimize potential disruptions. Now, this is what the Fed did at the last FOMC meeting back in December, right, where they communicated uh, an anticipation of 7 interest rate cuts for 2024, because back then they had seen the data and had come to the conclusion that inflation was going to continue to dissipate further. So that means the Fed was getting prepared and at the same time preparing markets as well that interest rates are coming. Now, before we dive into that, let's just look at how inflation has progressed over the last 10 months or so in the US. Right, so we have seen that it has actually eased quite significantly over the last 10 months, while economic growth chugs along steadily, right? And this is all accompanied with a relatively low unemployment rate. So it does appear that the Fed is on track to indeed deliver a soft landing for the US economy. However, we have seen recent US inflation data, particularly the CPI and PPI readings, coming in hot in the first quarter of 2024. Now, what do I mean by coming in hot? It means that they're coming in higher than their respective forecasts on a monthly basis as well as on an annualized basis. Now, this suggests that the battle against inflation isn't completely over and the Fed still has more work to do. Now, what could that mean? Well, it could very well mean potentially that the Fed is going to keep interest rates on hold at the current level of 5.25 to 5.5% for a longer period of time than originally intended. Right? Now, this could mean bond yields are likely to remain elevated. The US dollar is demand for the US dollar is likely to remain strong. So, of course, that could keep currency pairs like the euro, the pound, Aussie, and Kiwi under pressure, while helping to lift currency pairs like the dollar franc and dollar yen. Now, finally, let's explore how a soft landing could potentially impact financial markets. In theory, a successful soft landing is viewed positively by investors as it signifies a healthy and sustainable economic environment. So that means the stock market is not going to drop sharply, right? We may have a healthy correction, but it's not going to lead to another bear market as what we saw in 2022. However, the transition to softer growth trajectory may lead to increased market volatility and uncertainty, particularly as investors adjust their expectations and investment strategies. Now, this is something that we're beginning to see and gain traction as well as inflation looks to be persistent and sticky. So it is indeed going to be an interesting second quarter for 2024, and we will likely have to adjust our trading positions accordingly. Now, whether you're a intraday trader, swing trader, position trader, or longer term investor, we should all be paying attention to how the Fed is going to react to the incoming data with regards to inflation, the labor market, GDP growth, as well as the PMI activity reports. Now, this wraps up today's episode of The Soft Landing. We've examined the concept of the soft landing in the terms with respect to economic growth, labor market strength, and interest rates, as well as explored the Federal Reserve's role in engineering such a scenario, and also considered the potential implications for financial markets. Join us next time for more insights into the dynamic world of economics and finance. In the meantime, do remember to subscribe to our podcast here at IronFX, where we are dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned. Thank you.